Hi there, I'm Jim Loeffler, CPA, CFE, MBA, and founder of InTune Business Advisors, where for more than 20 years, we've helped owners transform their manufacturing businesses into financial freedom through superior business valuation, growth, and exit planning services. I've been talking a lot about debt in the last couple of weeks, last few videos. I want to extend that discussion today by explaining how you manage debt. In other words, when you take on debt, whether it's a line of credit, a term loan, maybe an equipment loan, maybe a combination of all three, how you look at that debt relative to your total assets and how the interest expense is affecting your net income. Let's go.
All right, well, here we are back with our favorite importer, exporter, manufacturer, Vandelay Industries. And I'm going to show you two measures of debt management that are really important. These are both measures that you should keep an eye on, and your bank is monitoring these as well. And they're certainly going to take a look at these measures when you go and perhaps apply for a loan. And the first one we're going to take a look at is leverage. And leverage is simply your total debt divided by your total assets. And basically what it measures is how much of your assets, or what proportion of your assets, are being financed by debt. Because your assets, there are two general financing sources for your assets, debt or equity. And in Vandelay's case, they've got assets ranging from $2 million up to $2.8 million, okay? But they also have some debt, and that debt is comprised of a line of credit, equipment loans, and a term loan. And so to calculate this, it's really easy. All you do is you add up all of your debt. So for example, they had $650,000 in debt in 2021. And then you just divide that total debt by the total assets of $2 million. And that is giving you leverage of 32.5%. But the way to interpret this is 32.5% of our assets is being financed by debt. Now, what's in a number? And you'll hear me say this a lot. In finance, many times it's all relative. And what I mean by that is, look at statistics in your particular manufacturing industry. What are other businesses of your size doing? What does their capital structure look like? And you're going to hear the term target capital structure. But basically what that's saying is, it may be the industry average is 30% or 35% of assets are being financed by debt. And certainly you can vary from year to year. No one is looking at this and saying, oh my gosh, you went up to 43% in 2022. That's too much. And it may be, again, these are year-end measures, but directionally, where do you want to be? And so you can see in our example here, Vandelay is paying down its debt, and it's managing it effectively, okay? So that's one measure. The other measure is interest coverage, or times interest earned. And the way we measure that is as follows. You take your net income, and let's take Vandelay's net income of $200,000 here in 2021. We are going to add back the interest expense on the debt of $57,000. we're also going to add back the taxes that they paid on their operating income. And we're going to add those three together to arrive at EBIT, which is earnings before interest and taxes. And that's the number that you want to take and divide by your interest expense. Because basically what this is saying is, okay, before we get to paying any interest or taxes, because remember, interest is tax deductible, we want to go and add those two components back to our net income and determine, okay, let's divide that $364,000 in EBIT by our interest expense of $57,000. And what that is telling us is that we could pay our interest expense 6.4 times, which is fairly healthy. Okay, that's telling me that you have a manageable amount of debt based on the interest. Okay, now if this were, let's say, 1 or 1.2%, that would be more concerning. Okay, but that's what this is measuring. So this is an income measure, if you will, and it's basically saying, hey, can we afford the interest expense of all of this debt? And obviously, the more debt you have, the more leverage you have. If your assets were, let's say, 70 or 80% levered, your interest expense would be a lot higher relative to your EBIT. And therefore, your interest coverage or your times interest earned would be a lot lower. So again, this is just dividing your EBIT by your interest expense, and that's going to give you how many times you could actually pay your interest. Okay? And you can see here that Vandelay is fairly healthy in terms of their interest coverage. Okay? Again, though, I caution you, understand what your industry measures look like, right? That's going to give you a good benchmark in terms of looking at these measures and determining if we're lower or if we're higher in any respect. That may not be a bad thing as long as there's an explanation for it. But those industry ratios and measures are very good benchmarks to know. So, I hope that helps in terms of looking at managing debt. And again, look at your leverage, which is your total debt divided by your total assets, and look at your interest coverage or your times interest earned by dividing your earnings before interest and taxes, or your EBIT, by your total interest expense. So that's it for this video, and I will see you in the next one.
If you're planning on buying a manufacturing business, raising growth capital, or selling your manufacturing business in the next few years or even in the next decade, click the link below to schedule a free call with me. I'm happy to answer any questions you have. Remember, you know your business better than we ever will. Let's make sure you get a great price so that you can enjoy the financial freedom you deserve. I'm Jim Loeffler. Get the insight, get the value, get in tune.